Hello and welcome to Gold and Silver Assets. It's Sunday, the 7th of February 2021. What a roller coaster of a week. The spot price of silver was very volatile and the retail physical market was overwhelmed, with most dealers running out of silver coins and small bars. But this isn't the first time this has happened, and it's unlikely to be the last time. That led me to come up with this week's topic for discussion: when cheap silver is expensive. When we talk about the price of precious metals, the most commonly quoted price is the spot price. That's the price of gold or silver for immediate delivery on the global commodity markets. Counterintuitively, the spot price does not reflect supply and demand of the physical metal. This is because it's derived from the paper markets, which exerts a very strong influence on the spot price. The physical price is the price you or I would pay to purchase physical precious metals, and it's the spot price plus a premium. Why does such a premium exist? Well, that's to cover additional costs that include things like melting the gold, producing blank rounds, designing the coins and striking the coins. Then there are the costs associated with transport, administration and insurance. There's also a markup to allow profits for both the wholesale and retail dealer. A common misunderstanding among those that are new to the precious metals sector is the assumption that premiums are fixed. Someone I know first bought gold back when it was priced at 1,800 New Zealand dollars, and at the time the premium was around 4%. He decided that he wanted to buy some more gold last year, and the broker was charging a 6% premium. And so he came and asked me, was he getting ripped off? Should he try another dealer? But in fact, his dealer was still giving him a good deal at the time, and the discrepancy was actually because the premiums do vary. What are the factors that cause such variation? There can be differences between dealers, so it's worth shopping around a bit, but having said that, the variations aren't huge, and I think that going with a trustworthy and reputable dealer is the most important factor, even if it means paying slightly more. Premiums even vary depending on which country and mint you're buying from. And of course, physical demand is a huge factor. And so a sudden surge in demand can send premiums soaring. At the retail level, the premium you pay will depend on what type of product you purchase. For example, silver coins will carry a higher premium than silver bars, and the premium will be higher for minted bars versus cast bars. Also, you will pay slightly lower premium if you buy in bulk. Now, I've got a question for our more experienced viewers out there. What kinds of levels of premiums for gold and silver coins were you seeing in the 1970s bull market? I actually struggled to find values for that on the internet, and so I'm interested to know that. So if anyone out there can help out, let us know in the comments. Looking at the past year, this chart shows that the premiums for physical silver, and you can see here that the volatility of the premium is quite evident. So what we're looking at is this blue line over here, and the scale is on this side as a percentage. We can see that premiums were quite high early in the year, and then they stabilized around here to around 20%. Last week, of course, saw a sudden and rapid rise up here to over 60%, and they've since cooled off a little bit, but they're still not back to that relative stable value. So currently they're around 40%. The premiums for gold tend to be much lower than that for silver. Early last year, the gold premiums were around 14%, so that's up here. Then that stabilized, so similar to silver, we got some stability at around 7% over here. But interestingly, note that the premium has been steadily increasing, and that's despite the price of gold dropping. And at the moment, the premium for gold is around 12% here. All of this data is for eagles, so that's gold and silver eagles, and this is all data that's been extracted from eBay by the website didthesystemcollapse.org. Now, some assume that premiums are correlated with the spot price and go up as the silver gold price rises, but that's not necessarily the case. So this chart here shows the price history for spot silver at the top over here, and at the bottom here we have the silver premiums. Here we've got a massive spike here, so it went over 75% there. And that actually occurred in 2008 when silver prices had crashed. In fact, at the 2008 low, the spot price of silver was $8.50, but those that tried to buy the physical metal were paying around $15 an ounce. Paradoxically, when the spot price was higher, they may well have paid less for the physical. Something similar also happened with gold, and although it wasn't nearly as pronounced as silver, what happened here was gold premium surged to around 8% in 2008, and at that time, at the 2008 low, the gold price was $681 an ounce, and the physical price was $732 an ounce. So not quite as bad as we saw for silver there. In conclusion, the physical and the spot price are not the same thing, and they're governed by quite different factors. The premiums do vary, and the premium for silver varies a lot more than it does for gold premiums. In fact, silver premiums can surge to such levels that when the spot price of silver is cheap, the premium can make it much more expensive than you might expect. Even more of a concern is that when the silver or gold spot price is cheap, you might not be able to get hold of any of the metal. I think that this is likely to be an increasing problem going forwards. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And this whole correction here has been rather long, drawn out, and actually I personally am getting a bit bored of it. I don't know about you. And the thing is, it's times like this where people start to get concerned. They start to become fearful, particularly when you get big candles like this moving downwards. There's a lot of uncertainty and doubts start to creep in. But of course, when those feelings occur, often price just turns around and moves up. You know, price tends to charge upwards when people are least expecting it. But yeah, I think people are feeling a bit despondent at the moment. And so my mission today is to try and cheer everyone up, okay? Maybe I'm being delusional here, but look, I think we should keep our chin up here, and I'll explain why. Okay, so with gold, yes, we had this awful move down here. That day was particularly dramatic there, and we came into this zone that we've been talking about for months and months now. But interestingly, although it dipped into there, it bounced back up again. It doesn't like being there very much, as we saw here as well. So that's a positive thing. I still see this as being a correction. I don't see a trend change occurring here. It's quite common for people to start to be concerned, particularly if we go down here. I'm sure there'll be people who will have visions of $1,400 gold and so on. I'm not feeling that. I'm still going to be on the bullish side because I do believe we are in a bull market, and if that's the case, then this would be a correction. but only the market can tell us for sure. Nobody knows for certain which way things are going to move. In terms of downside, can we move further down again? We could dip back into here again. A good sign would be if we were to go back down here, bounce back up again. That would be quite positive, I think. The nail biting thing to know is whether we're going to break this low. And remember I said that I thought this was at or near the bottom. So if we do break this low, there's potential to go into the mid to low 1700s. But I think if it did that, that would just flush all the remaining people out, really. All the remaining bulls would be crushed, I reckon. And then you'd get a quick bounce back up. You know, we saw a big bounce up here, kind of a V-shaped one there as well, and here. So I think the same would happen if we were to get into this territory. But for now, let's concentrate on this zone here. I think price action is going to be a bit messy. And let's just have a closer look at what's been going on here by looking at gold priced in US dollars on the hourly scale. So this is the drop into that zone. So the zone is over here. And as we saw, price bounced back up. But the good thing is that it hits the top of that zone there, which is I've put it here at 1808, but that's been pretty reasonable so far. It got rejected from there, but then it just charged straight through there. And in the last session, price just bounced off of there and moved up. Whether that continues remains to be seen, but at the moment, certainly on this time scale, we are in an uptrend. Let's move to silver price in US dollars on the daily scale, and this really has been a roller coaster. This price action was pretty rapid, and it went to make a new high above this high over here, so just above $30. But of course, whenever you get rapid, sharp moves like that, it's quite common for punishment to occur, and punishment came in the form of this red triangle, red bar over here. But we've been talking about these support and resistance lines for quite some time now, and again, that 26 level has shown to be some good support there, and we've just bounced off of that. I had drawn this trend line over here, which joins the March low to this low over here, which has been pretty successful so far. We haven't breached that. If we do breach that, then that would change our views dramatically. I'd be a bit more bearish there, particularly if we breach this low over here, so going below 22. And I know some people have been talking about $20 silver. Me personally, I'm not convinced that's going to happen. I think that this trend line is going to hold. We might not even reach that trend line, to be honest. If we do go back below 26, then I'm thinking around here. So we're talking about the 25 level. I think that would be support here because of this price action over here before we turn around. And we've kind of got a little, you could draw a little mini trend line over here, and that may give you where the bounce occurs, which again would fit in with this support area over here. So yes, I'm still bullish on silver. In terms of potential downside, seems pretty limited over here, really, unlike with gold. And I also would say that this price action is going to be messy for a while because we've got all of this area to tangle with. We're not just going to go shoot up and go straight above 30. Okay, so for me, I think this is all price action that's realistic and it's still within the bullish thesis. So now, remember last week we were talking about this price action over here, and I was talking about fractal patterns, and actually, I didn't get pushback from that. People were quite positive about it. So I'm going to push that a little bit further. Remember, it's just an idea. I don't know that for sure that this is going to happen. But look, when we look at this, if we just try and translate this to this, it's quite difficult for our brains to comprehend when this is going to happen in terms of timescales, because obviously this is a much larger version of this potentially. And so, you know, your natural thought is, oh, well, this is going to happen quite quickly and, you know, this could happen by March. But the way to overcome that kind of difficulty with kind of judging those kinds of timescales, and it is a difficulty. I find that I tend to think things will happen sooner than they actually do. And so to try and do this a little bit more objectively, there's a function on TradingView where you can actually copy these bars and then you can expand them to fit however you want it to. So this next chart is what I've done. So what I did was I copied the bars from here up to here. Okay, so I'm working on the assumption that this is the trajectory we're going to take with this price move here. Now I know there's lots of assumptions with that, but look, let's just play around with this as an idea. Okay, so don't freak out with this next chart. Here we are. Okay, so now what I've done here, these bars were obviously on a daily scale, and so I've upped the scale here to the weekly for the current price action, and I've overlaid these bars. Now, this is quite a subjective thing potentially, so what I've done is overlaid it so that the highs coincide over here and over here, which is the recent high where it hit 30. And so that coincides with the two highs that we saw in the preceding price action. I also tried to get the low to the same level as the lows that we saw here as well. Now, obviously, they don't coincide exactly. We're not saying that the price is going to move identically. We're talking about trajectories here. Another note is that each of these bars are just the absolute high and the absolute low for that particular day. And so it just kind of gives you a price range roughly. And I thought it was quite interesting because it seems to be following the similar trajectory here. The shape is pretty similar. Obviously, the lows aren't exact. We have gone a little bit lower over here, but then it recovered again. And we're back down to just below that bar there. And so if that's the case, that would fit in with our theory of that trend line that I had drawn. And, you know, on here, it seems a pretty good straight trend line that we're looking at here. Okay, so what does this tell us looking forwards? Well, it does tell us that we've got a bit more sideways grind to come. So it's going to be frustrating for a lot of people. And according to this, we're not going to breach 30 until kind of late March, really. And from there, we're going to get stuck between the next trading range, which is between 30 and 35. Where does that 35 come from? Well, if you look back at the price action on the monthly chart and go back to, I think it was about 2012, then you'll see lots of chunky bars, and that is kind of at the top of those chunky bars of price action there. And it's interesting because this trajectory suggests that it would get stuck there. Don't ask me how that happened. I haven't drawn this to fit with that at all. I remember that I did it just to fit with these two highs and the lows here, and that's just come out like that. Obviously, it's not exact, but that's what the area that I'll be looking for when we reach that stage. And then according to this, sometime in May, we'll break out above the 35 and get a massive rise. Interestingly, it will, according to this, it's going to shoot through the 50 level. I thought the 50 level might be a rejection point, but according to this, it will go above it, maybe form a little flag there, and then go up to about 75. But at that point, we're going to get a massive smackdown. Look, I think beyond here, it's a bit, I'm not sure if this is all going to happen, but this is suggesting that we're going to go up to 90 or 100. I don't know. What do you think? Do you think this is a possibility? If so, then obviously this area here is one thing that we would be concerned about. So in July, this suggests sometime in July. Now remember, this isn't going to be exact. It could be August. I don't know for sure. This is a ballpark thing. But this suggests that something's going to happen probably in the third quarter actually, which is going to cause a big smackdown. And that's going to frighten a lot of people there as well. But then it's going to recover pretty quickly and pretty sharply beyond there. Yeah, look, I don't know if this is completely crazy idea or what, but the way I see it is this could be a model, and look, models break, but until they break, they can potentially be useful. And so far, it looks all right, but we will only know if we look at this prospectively. Remember, this is all retrospective fitting, really, isn't it? So, I don't know, just something to watch and see. Obviously, if price does something completely different, then we can just chuck this out. But it's just one idea, and I thought it was just an interesting thing. And the other thing, it kind of sets our expectations. And it actually, I don't know, these expectations fit in with these resistance and support areas that we've been looking at for some time now. Interesting. Okay, let's move on to the gold miners. So this is the GDX on the daily scale. And price didn't move down as much as gold on this one here. I don't know, it just didn't seem quite so dramatic to me. But we've kind of reached this area here. And I think the reason that we've kind of stalled around here is because this action over here is being supportive as well as here, actually. I still think 32 is going to be pretty strong support, but it may not even get there. Let's see what happens with gold, really. If we do get that further leg down, then yeah, we could dip into this zone here. But yeah, it's hard to draw much conclusions from this chart here. Let's move on to the silver miners. This is the SILJ, and again we saw some major dramas here. And last week I mentioned that we'd had these 3 red bars, although the price had moved up quite dramatically, and that's just something to note, that it's quite rare to see this kind of price action. If you look back at previous charts, it's rare to see price moving up dramatically but all the candles being red. Usually when you get dramatic up moves, the candles are green. So what does that tell us? Well, each day what's happening is that price gaps up and then gets pushed down. And then the following day, price gaps up and then gets pushed down by the end of the day, and so on. So that happened multiple times. And yeah, we did break above this channel that I've been talking about. But I think because of the way this is behaving, it looks like it may have been a false breakout. But it's actually a good sign that we broke through that, you know, because it means the next time we come to that, it'll be that little bit easier to move through. Anyway, that didn't last very long. Price gapped down and moved down further, and that would have been a bit scary. I'm sure many of you were frightened for your silver miners. But remember, we're still in this sideways channel. We're in a sideways trading range. And until we see a new directional trend, you know, we're going to be up and down within this channel here. We can't know for certain which way this is going to go. but I'm still plumping for the upside. Like I said, I'm still bullish on the metals and the miners. That doesn't mean we can't go down first, and I think if we do drop again, then I think 14 is going to be a reasonable area. But we may only we might not even get that far. Let's see. It depends what silver does really. But yeah, probably the downside would be 14 at the very most. We could retest this lower trend line, but I think we'd bounce back up of it again. And when we move up, we don't want to see anything dramatic like this. We want to see a steady move up with lots of green candles. Let's hope for lots of green candles. Okay. So yeah, I've tried to make this as positive as I can. I know it's a bit of a grind, and based on what we're seeing, there's probably going to be a bit more grind to come. But, looking, as I talked about in the first part of the show, prices may have been smashed down in the metals, but, it's pretty hard to get hold of physical. Certainly here, there's a 6-week lead time to get hold of physical silver. Actually, there have been delays in getting hold of silver for some time now. It's not anything new, but it's just been exacerbated more recently. And I'm just not hearing of people selling their physical lately. So, whatever the paper price does, I still feel very happy in terms of the physical. And actually, the physical price hasn't dropped steeply. So, that just makes me feel like you've got to keep your chin up, hold on. This is a bull market, and the bull is going to try and throw people off. Right, well, that's it from me for this week. Hope you're all well. All the best, and see you next week. Bye.